Welcome to this new episode of Your Next Trade. Today it's episode number 23 and we're going to be looking at SVB Financial and asking ourselves if SVB Financial will be the new Lehman. As always, we're going to be talking about markets, looking at what happened during the week across asset classes, what have been technical analysts telling us, and then we're going to be looking at catalysts. But first, let's start with SVB Financial. So SVB Financial with the ticker SIVB was trading until Thursday on the New York Stock Exchange and was halted on Friday morning. And we had the news that Silicon Valley Bank collapsed and entered FDIC receivership. So if we look at the stock, the price action since 2000, the stock went from the single digit to 700 more and was halted when the stock closed at $106 on Thursday. As you can see at the bottom of this of those two tables, those are the assets and how the assets have been progressing over the last few years. So if we go into the next page, looking at in purple, the market cap versus the assets which are here, you can see how those assets have been going up drastically from 2020. So from 2020 to 2022, assets went from 50 billion roughly to more than 200 billion, so a change of 150 billion. And over 12 months, they went up about 100 billion. The reason was access to money in the US. So a lot of, as you know, of US citizens get fiscal stimulus, but as more importantly, this bank, which is in California, was the bank for private equity VCs startups. So a lot of VCs put their money into this CIVB, and that was really the hub for many private equity in California. Now, when you are running a bank, you have roughly two columns. You got your assets and you got your liabilities. So this is what we call the assets liabilities management. So when I started to work, when I did an internship, to give you an example, 25 years ago, I was, fascinated by going into the trading room and seeing the traders trading stocks, bonds, futures. And I was not that much interested by a boring guy, what I thought it was a boring guy, which was running the asset liabilities of the bank. So more or less what you have is you get clients that are depositing money at your bank, and with that money that you are leveraging, you are either giving a loan to companies, to businesses. So this is what SVB was doing. So giving loans to private equity startups. And in the meantime, if you don't use all your money, you'll be investing that money. And you can be investing that money in stocks. And most of the time, you will be investing in safe haven investment, which will be T-bills, which will be treasuries. So what we end up here with SVB, they had a book where roughly the duration of their book was 5 years. So they were stuck in their investment roughly around 5 years. So as long as you're holding those bonds until maturity, so that means held to maturity, that is fine. But to hold those bonds to maturity, you need to make sure that no one at any point in time is going to withdraw too much money, and you have to, if that is the case, if people are withdrawing that money, that you have to sell the bonds that you thought before you have to hold to maturity. Okay, so as long as you don't have any withdrawal, that is fine. But when the outflows start to kick in, then you are in trouble. And this is what happened from 2022 with SVB. So the first problem was the assets liabilities management, where you got an interest rate risk here, this is here, with your duration. So the first risk that they were carrying was an investment risk. If you are holding a lot of bonds, so let's say in 2020, as we saw, they had roughly 100 billion of new money coming between 2020 and 2021. Out of this 100 billion, you put 60 billion, let's say roughly, into treasuries where your duration is going to be 5 years. Now you look at this chart here, which is the futures for the 5 years, which went from 120 to 105, so roughly down 15%. So if you have 15%, down of your L2 maturity, so mark to market, what we call mark to market, which is the price right now if you had to sell, of 60 billion times 15%, that makes roughly a loss of 10 billion. But in reality, at the end of 2022, and that was official, that was in their books, that was in their 8K, they had 15 billion loss. So 15 billion loss versus equity of 16.2 billion. So their equity in their balance sheet was only 1.2 billion. So very, very small, using huge leverage. So what they had to do is to be raising more cash. So you have to do a fire sale of your existing bonds, okay? You sell them at the market very quickly to someone that is buying, and you are using as well probably more access to the Fed of California by having a loan with them. So first thing first, they were wrong on their investment. So what has been happening, everyone is looking at yields going up and thinking, okay, some companies will be struggling. Who are those companies? What has been happening, you'll be looking at banks who had huge increase in their assets. And in the meantime, I've been investing in bonds with long-term maturity, long duration, 5 years or plus. But when those bonds are coming down, when the yields are coming up, bonds are coming down. So that means you are facing big losses. So if you do the mark to market, in reality, you get very little equity. So that was the first reason and the biggest reason of why this bank has been struggling. And the second reason is obviously part of your assets, what you put against your assets in terms of your liabilities, when your asset liabilities management, you're making loans. And you're making loans to who? This company, this bank has been making loans to private equity, VCs, and anything that is NASDAQ startups has been doing very well until what? Until October 2021. And since then, any of those investments have been done 50 to 70%. So that means your long assets to, let's say, 40, 50% of your book that are going down 50%. And as well, most of your clients are experiencing a slowdown in their businesses. Okay, so you get less IPOs, you get less placement, you get less flip from one private equity to another, and the underlying economy is deteriorating. So if you look at that chart here, this one, you can see that they had a lot of deposits, but those deposits are mostly into early stage technology. So as long as your money is sticky and you don't have to mark to market, it's fine. But what has been happening is over the last few months, there has been an acceleration in outflows. And here, this is a stellar number that was in the news. On the day of that was on Thursday, they had 42 billion withdrawal, 42 billion. That means that was just impossible for them to carry on. So going forward, what's going to happen? So is it a systemic risk? Is it like a new Lehman? So I was active, and I'm still active, but in 2008 when we had the bear stearns and then the Lehman. So the size of the Lehman had 640 billion roughly of assets at that time, where bear stearns had only 20 billion. So in terms of size, you are in between. It's not as big as Lehman. You can argue that it's more concentrated into private equity VCs which had a good time and raised a lot of money. So it's kind of normal in a way to revert into the mean. If unfortunately you've been a client in the US of this bank, you are insured up to $250,000. But there will be a match between the assets and the liabilities. It feels very much like going to the readings that probably you're going to have 80 cents on the dollar. So if you had $100 there, you might recover up to 80 cents, but $80, sorry, not 80 cents. But in between, it's going to be taking time to recover the money. So trust me, I've been involved in a fund that was using Lehman. It takes 2 to 3 years maybe to recover the money. And in between, some companies, some private equity that are putting money that were using this bank are going to be struggling to pay the bills, to pay their employees. So there's going to be a mismatch in terms of timing. So there is still a systemic risk. You can argue it's small at the moment, but that tells you that actually there is a first big shock in the system. We are talking a 200 billion 200 billion assets like a couple of months ago. A company that we saw was almost a 50 billion market cap like 18 months ago. So in terms of ID generation and what is your next trade? So ID generation, when I do the mentoring program, when we look at banks, we do the big banks and we do the regional banks in the US. The regional banks, you're going to do as usual, you're going to be looking at book value, at price to book value, at return on equity. And you're going to see that most of those regional banks will have higher return on equity because it's more risky. But what is important is always to be looking for any of those banks where they are in the US. So here you get a good idea because it was in California. You don't need to be a genius to know that in California, it's mostly private equity VCs. So you knew the risk. So in hindsight, it's pretty easy to say, oh, that was coming because VCs, private equity. So actually, this is a bank that I've been looking over and over, and I didn't put the trade. So, but some guys smarter than me have been putting the trade. So well done to them. In terms of your next trade, you should be looking always at where is the bank exposed in terms of geographical exposure, who are the clients, where is the growth coming from. And now for the next trade, it's what are the companies, what are the sectors, the industry that are that exposed as well to interest rates, okay? A mismatch between your business, a mismatch with your balance sheet and where the interest rates are moving. And we are talking banks, we are talking insurance, and we are talking obviously at companies that are way too leveraged. So I hope it helps in terms of understanding. There was a mismatch in the asset liabilities management. So this is for the investment part, and as well the core business, which is private equity, startups, is obviously something that has been suffering a lot. So you get the second derivative of the yields of the rates going up, and the second derivative of the business, the startups, the VC cycle ending or at least down 50 to 80%. So let's go back to the year-to-date asset performances. Looking at stocks first. So we got the S&P now almost flat on the year. Nasdaq is outperforming at 6%. What is interesting is because I'm sitting in Europe and trading a lot of Europe. Europe is the outperformer with the stock 600 up 11%. So a big outperformer. I don't know when it's going to catch up with the US, but it's going to happen because to think that there is no leverage company in Europe, that there is no war, that there is no inflation, that there is no nothing. It's just that mostly what is happening, there's a lot of inflows going into Europe with CTAs and investors thinking that Europe is immune. There's going to be a catch-up. So year-to-date performances of the US dollar, up 1% versus euro roughly. We have been trading in a range, a bit of weakening as we're going to see later during the week. So what about crypto? Crypto down up 20%. There used to be up 40%. If you think about what is happening with SIB, which is another bank. So you have many banks that have exposure. You have roughly two banks that are doing businesses for crypto funds. And one of the two, which is Silvergate, has been closing, and the other one has been struggling. So if you have been doing business in that space as a professional, literally the only prime broker that you will find will have been those two banks. So what they have been probably doing is they have to be closing their position and probably as well withdrawing money from those banks. Let's go into the next slide for the week to date, because this is a pure risk-off week, at least for the stocks. We got S&P down and the Nasdaq down roughly 4.5%. The Russell really underperforming. So the pure US stocks are more exposed, or companies that have more exposure to the US have been underperforming. That is explained as well by the weighting of regional banks and banks that have been really underperforming for the week. Stocks 50 down 2%, so not that much, but really most indexes down. Dollar flattish on the week, but there has been the start of the week and the end of the week. As I said, crypto is risk off, but as well there is a lot of banks that have exposure now, and people are just scared to keep that money there. Year-to-date industries performance. So left-hand side, we get the silver, but more interestingly, we get those two, the regional banks and the bank. S&P is around here. So you do have like a 50-50 between underperformers and outperformers. Semiconductors still doing very well with airline transportation. So a bit of strong performance for semiconductors. Week to date, that is a pure risk-off week with the TLT, 20 years treasury, so long-term treasuries, long-term bonds doing well. Other end of the spectrum, banks really off. S&P, which is around here. So a lot of underperformers versus the S&P for the week. So a pure risk-off. On the sector, year-to-date sector performance, now we get telco, consumer discretionary that are up almost a double digit, but a lot of sectors, even the defensive one, the healthcare, the anything that is yield or rates, energy as well has been struggling. And for the week to date, that is the overall picture with XLF, the financials down 9%, energy down, everything has been down. So now moving into the rates, because we had a big move in rates. So actually the moves in stocks have been pretty small versus the bonds. So if we look at the US 10 years, which is now at 3.7%, we had a week to day change of 0.2 of 25 bips, which is 0.25%. So that is huge. And we went not so long ago to 4.10 at the start of the week. So we went from literally 4.10 to 3.7% on the 10 years, like 40 bips change on the risk off, on bad positioning. And if you look as well of the yield curve, the 10 versus the 2, we were, I think it was on Wednesday afternoon, at minus 110 bips, and we finished the week at minus 90 bips. So that is explained first thing first by this risk off, and I think as well a lot of positioning into the short hand part of the curve in 2 years and below, to CTAs, extreme positioning, and as well of scare of the of this SVB and the regional banks and the banks having an effect, and saying the Fed is going to jump in. So more importantly, looking at the euro dollar, big change for the week. So this is the terminal rate. So the terminal rate now is back to June, whereas not so long ago it was September. And I just want to flag the change on the week between last Friday and the last year. So if you take the December, for instance, December went from 94.46 to 94.90. So that's a 44 basis points change. That is just huge. And if you look at this chart here between the blue and the red, so red was last week, everything went up, meaning we are expecting the Fed to be much more accommodative than a week ago. Why? Because the market, it's not the NFP. It's just like people now are expecting, based on the SVB and the risk of contagion, very quickly we change a lot. So it's going to be interesting to see in the next 10 days how it's going to unfold, because we're going to have, as we're going to see later, the CPI as a catalyst, the PPI, but the Fed is in the FOMC is on a quiet period, so they can't say much. But the moves in the bonds, in rates, have been absolutely insane over the last couple of days. So that's really the space to watch. If you're like me, you are a bit of an idiot and you're trading stocks, the space to watch are the bonds. Looking at the VIX, so VIX now we are almost at 25%. So you see this big move where the VIX future term structure is a bit all around, but it's kind of staying almost flattish now, whereas normally you will have something like this. So all the risk parameters are telling you that we have been on risk off. You don't need to be a genius to know that. So let's look now into the technical analysis, looking into up, and I'm gonna go into that space looking at the S&P first. So S&P, I'm putting a daily chart. So that was the trend. As I said before, I thought it was a bull trap. We are still above this trend line, so we have not been below this trend line. If you think about options positioning and the OPEX coming, so we got the OPEX next week, but we got this big JP Morgan fund that is having a big position from one quarter to another, and you get on the left hand side you get the 3650 as a support, and roughly on the upper side you get the 4065. Okay, so the magnet for the end of March will be 3650. It feels very much more that we are going into that space, and obviously this week as well, if you look at the Nasdaq, has been pretty painful. Feels very much like we're going to be testing lower. So interestingly, you remember or you don't, 3 weeks ago, everyone looking at the S&P, the fear of missing out, and was telling you 4200, and we're going to go much higher for XYZ, and we are talking of tons of people on Twitter, for instance, and now those people are very quiet and still telling you, oh, that is fine, you know, we're gonna go higher. In between, we are down 5 to 7%. So what about the Russell? Russell, the picture is not that great, and that's an understatement. Feels very much like we could be testing, you know, this 1630, which gives you 8 to 10% lower. Emerging market, similar picture. Now we are testing the levels that we had at the start of the year. So is China reopening that quickly? To me, so I closed my position, as I said before, on the S&P. So that was that was last week. I had a put spread. Unfortunately, I think I closed too early, as always. So no back trading, but I switched this S&P into more short into Europe. So I'm pretty short Europe through the stocks 50, and I think both the drivers, the city economic surprises, everything, and now hopefully the technical are telling me that we should go lower. We are below the 50 days moving average. We see if it starts to go my way. CL1 still consolidating between 70 to 82. We are waiting for a catalyst. On the positive side, you might argue that the economy might restart, which I don't think so, but you know, a lot of hopes into China, and on the end of the spectrum, this is the recession where I think we might go in the next 6 months. Copper is giving you the same picture, trading sideways, waiting for a catalyst. So in terms of pure economy, there is not much of a catalyst. What was interesting from yesterday on the euro dollar, so normally when you get such a risk off, the dollar will be strong, but as yields were absolutely creamed and yields came down a lot, bonds were really strong, the carry trade and the attractivity of the dollar was not that big yesterday. So we had a strong euro versus the dollar yesterday. Just a quick chart looking at the regional banks, and here I want to give you a very long-term picture of the KRE, and that gives you a bit of you know, understanding of a bit more understanding, yes, of how KRE has been doing over the years and what has been the move over the week. So if you think about reversion to the mean could be into the 35, 35. So you might have another 30% on the way down. Let's go back into the Excel spreadsheet and looking at what has been happening this week. So drivers that we identified last weekend. So we look at Powell. So Powell was talking this week on Tuesday and Wednesday. He was more hawkish than usual, with no surprise at the end. You know, you're not going to come in front of the Senate and say, you know, the inflation is under control. He could not say that. He said that he's still looking at inflation. Inflation is way too high. And what he said that is important, as always, the same for any central bank. So he was data dependent for any data, most data. So that means CPI next week is going to be important. We had obviously the big move, so the big move on the US 2 years. So here I take the example where we went from above 5% to 460. So that's a 50 bips move that is just huge. On the other end of the spectrum here, this is the Fed fund rate December, where we move from 94.45 to 95 plus. So really big move in terms of the Fed being, let's say, more dovish, more accommodative, probably reason being not necessarily the economy through the NFP, because the NFP were more or less in line, but more because there is stress in the banking system. So if you look at how to generate ideas, and this is something that I try to flag on Thursday when every single day on the, at least so far on the Discord community, I put the pre-market in the US. And it's pretty obvious that when you start to see SIVB, the SVB Financial pre-trading down 30%, you know you don't need to be a genius. You know that there is something to watch, something to monitor. And that was pretty obvious that from early Thursday, that pressure was building in the market. And if you look at the move on the carry on the day, so that's roughly a 5% move. So that has been the biggest move of the last couple of years. So going forward, what do we have in terms of catalyst? So in terms of the Fed, this is the Fed quiet period, so don't expect much. And that could be a bit of an issue because actually with the pressure that we had in the regional banks, you will love for some of the Fed speakers to come. It's not going to be the case. I still believe that over the weekend we might find a solution, and we might hopefully we're not going to be opening on Monday without any kind of resolution. What about the CPI? Important inflation. So CPI on Tuesday and on Wednesday, the PPI. So recently the moves of the S&P on CPI days have been positive. The last one on the 14th of Feb, the market was flat. Before that, it was positive. So the market kind of reacted positively over the last 5 CPIs releases. We're going to see again on Tuesday, what's going to be the reaction. In terms of other catalysts, we get the retail sales on Wednesday. Positioning, very important, option expiry on Friday. So here we are in a very negative gamma in terms of positioning, which very often the move on the S&P will be even more on the way down in the next 5 days, extreme positioning. And other than that, we had the CTS positioning. So that is something that I mentioned, I think it was a couple of weeks ago. How are the CTS positioned? So they were very short bonds, very short 2 years, 10 years, even Fed fund rates. So on Thursday and Friday, they get absolutely killed. They were already down 2 to 3% for the year. So they had an exceptional 2022, but struggled so far. And the last couple sessions, they struggled even more with being short bonds, because as we saw, yields went up 50 bips. So they are suffering on that part of their positioning. The only part where they are still okay, which has been being long Europe, and I'm pushing it because I'm short Europe, and being long the world versus the US. I think that there is so much pressure in the bonds and we are getting closer to the flipping level for both the Europe and MSCI. We are probably 2%. They are 2% in the money. If we are getting closer, they will have to sell those positions. So watch, CTS positioning, watch this level. And obviously, you need to be looking at if there is contagion into more regional banks. I'm looking at SBNY. You can be, I tweeted, I think it was on Friday, some of the names, some of the banks that experience huge growth of assets over the last couple of years. That might be good for ID generation. Finally, looking at what is the market pricing in terms of volatility for the week. So over the last 3 to 4 weeks, the market through the straddle, the at-the-money straddle on the SPY, which is the S&P 500 ETF, was roughly pricing a 1.9% move, whereas for this week, we are now pricing a 3% move. What has been very true until Wednesday is over the last couple of months, investors, traders were mostly selling volatility, implied volatility, and actually both implied volatility, realized volatility were coming down and down and down and down. So they were selling implied volatility, and on an intraday basis, on a weekly basis, was working very well. It didn't work very well on Thursday, and it didn't work awfully on Friday. So the strategy of always selling the volatility now is not working. Be careful, because it's not because something worked for quite a long time that is not going to be. It's going to be working in the near future. More importantly, when you go short volatility, you could be facing like huge downside. And that is something that some people experience in 2018. When the VIX goes, when volatility goes, it can be very dangerous. So as always, I hope it helps going through the SVB and what has been the SVB bad management of assets, liabilities, bad management of their risk, interest rate risks, and as well their exposure to private equity and VC. So if you got questions, you can join on the Discord. We'll be happy to have you. If you get questions on the 4x4, and if you want to get a real investment process, you can do the 4x4 video series. Visit the website and ask questions on the mentoring. As always, I hope it helps, and I'll see you next week. Bye bye everyone.